Good evening, everybody. Welcome to GRA's Economic Update and Property discussion this evening. My name is Matthew Gilligan. I'm your host for the evening. Tonight, of course, is the first of a series of 4 or 5 seminars, possibly more, for this year. And it's my pleasure to have Tony Alexander on the presentation this evening, who's obviously a very well-known economist and property guy in New Zealand. So this evening, I'm going to be going across my own portfolio, just giving you a bit of update on what I've been doing, and that's the strategy side. And then Tony's going to come on for the economics. So this workshop series is a bit of a work in progress. We've got some election content coming. We've got a finance update, a tax update, and next week I've got a property zoning and RMA update with Simon O'Connor, who's a very good planner, and there's so much ground to be made for property investors by understanding what's going on with zoning. So that should be very, very useful to you. But tonight I'm going to start off looking at some of my recent investments and really using those as examples to bring to light what I think is going on with property. And that's part of GRA's culture as a firm. We show you what we do as investors, and if you attend our workshops and use us as advisors, we're very open book. We give you our numbers, and the culture is copy what we do, get what we get. So I'll show you a couple of things that I've been doing. Then I'm going to go through some market feedback, what's going on, which is the theme of tonight. And I'm going to just give some feedback that I've got from the community. I like to ring up people who are at the coalface. So I ring builders, mortgage brokers, real estate agents, and ask them what's happening with property in their area. So I'm going to do that. And then I'm going to hand over to Tony, and we'll have his presentation. And then following that, we'll have Q&A at the end. So welcome. Hope you enjoy the evening, and hope this helps you with your investing. For those of you that don't know me, I'm a chartered accountant. I'm MD at GRA, which is a chartered accounting organisation. I'm a fairly active property investor and property developer, and I'm also the ex-head of the tax team at GRA. These days, I tend to run the property side of things, but I do know my way around tax. And this evening, we'll be looking at some of the developments and more recent property activities I'm involved in. And here they are here. Actually, it's interesting because I had a lot of clients saying, where are you? You've stopped running workshops and haven't been posting much on Facebook, and I've gone quiet. Well, the market's gone dead. And I think that the experienced investors tend to sit back in the down market and get going in the up market. So I did get to the end of 2020, and I picked that as being the peak, and I sold fairly much everything that I had that I didn't want and cashed up. And in 2021, I started this. It's a bare land development in Darfield. It was a 7-hectare block. It was listed as a lifestyle block, but I saw that it was high density. And so I've got a business partner down there, Peter Montgomery in Canterbury, and we do a lot of earthquake housing together, remediation and sale. And so we spotted this together, and we bought this 7-hectare land. It was marketed badly and as a lifestyle block, and it was high density. And to our great joy, the government infrastructure fund put a sewer pipe right past the end of our land, and it meant we could get 81 lots on it. So I did that in 2021 and delivered it over 2022, and it's all sold and completed. So that went really well. It was a pleasure to hear one of the BNZ bankers say to me that it was the most profitable land development he'd ever seen. So that was a great result. Another thing that I'm doing in this market, which I'd encourage you guys to take a look at, is go out of Auckland. The rents out of Auckland are skyrocketing, and the yields are really good. And with MDRS rules, medium density residential standards, which some of you will have listened to my workshops on, the opportunity is to take advantage of what we saw happened in Auckland. In Auckland, when the unitary plan came in, everybody started building high density houses, and the ability to get in early and be first cab off the rank can be quite profitable. So we've been amassing a land bank, I guess you'd call it, down in Rotorua. We like Rotorua because it's shorter supply. It's close to Tauranga and Hamilton, so it's within that catchment in there. It's got strong employment fundamentals. So we've been buying 1,000-metre sites down there. They're very inexpensive. They retail at sort of 550,000 with a house on them. The same land in Auckland would be $1 million at least. And we've been tanking up on these. And with MDRS, each area across the country, which is benefiting from the intensification and zoning rule changes forced through by the government, with those rules coming in, you can benefit from this right across New Zealand. There are other places, but we've chosen Rotorua because we think it's short of supply. And so these 1,000-metre sites, we can put 12 to 20 units on each site, and they seem to be standing up in profitability. So it's this sort of thing that you can do in Rotorua, and that's what I'm moving into now. I've been struggling. I don't know what you guys have been feeling, but I've been really struggling to make the Auckland market work from a development perspective. Construction rates are through the roof. House prices are down 25%, and so that's a terrible, terrible mix. Freestanding townhouses have not been making money on the whole. Medium density terraces, 5, 6 terraces stacked together, have not been particularly profitable. And I've found, I had a dabble at high rise, tried to make high rise work, and I found that to be very unprofitable. Of course, new builds are doing well with the tax exemption on them. So this is the high rise block that I had to go at actually this year. And by the time I got 500 lines through my spreadsheet, I found that it was $5,500 a metre, near enough. And it's just not profitable. It's not viable, 3.3 million on 23 million. So I canned that. And what I have found is that these still very intense 3-level walk-up units are quite profitable. And so for those of you looking for profit in the development area, you should look at this. Three-level walk-ups. So that if you look at this building, you get 3 65-metre units on one side, a walk-up set of stairs in the middle, and then 3 65-metre units on the other. That's the format. Now, Simplicity Living are doing this all over Auckland, and it's such a cheap way to build a property because you have a slab, you do in situ concrete, then pour another slab on top, or tray deck, and then you repeat all the way up to the top. And you actually get your roof on inside 6 weeks, and you can build very large buildings very quickly, and it's cheap to build. So I'm not going to go deep dive into this, but this sort of thing is actually making money. I've put some numbers on there, and this is viable even in this down market. Another thing that I'm seeing as an opportunity for investors at the moment is apartments in the CBD and in the suburbs around Auckland. So I'm not speaking about the rest of the country because I don't know the rest of the country, but in Auckland, apartments have always been really volatile, and they seem to drop up to 50% in a down market across the property cycle. And once again, we've had an event that's really affected Auckland CBD. It's had a really hard whack with COVID, the loss of students, and apartment prices have really fallen. There's a lot of distressed apartments around too, leaking. Tends to cost $200,000 to $300,000 to fix them, and a lot of the investors don't have the money, so the assets are given away at very cheap prices, and then you pay to fix them and they recover in value. So there's very good cash yields in this area for those people looking for yields, and it's worth chatting to any of the people in the Auckland CBD about this. But apartment specialists, I've been dealing with them. They haven't paid me to say this, they don't know I'm saying it, but I've found their advice to be very good. So go and have a chat to them. So that's where I've been up to for the last couple of years, pretty much shutting down all my operations apart from doing a bit of land development and looking at some larger blocks of units. And, little wonder that you become less active when you see a market like this where everything is falling. And we've seen right across the country, house prices fall 20 to 25%. And that's the average for the area. Within the area, there are some people losing a lot more than that on their properties if they're forced to sell. But let's not forget that still house prices are up 10 to 20% on pre-COVID levels. And if you look back at this, big picture, money printing happened with COVID. It pumped a bunch of cheap money and loose liquidity with LVRs being relaxed, pumped up house prices, and here we are 2 years later, and with the interest rates being pushed back up and the money supply tap turned off, asset values have crashed back down. But if you look at line of best fit, I think we're actually getting back to sensible prices, and we should have a normalised market return. And I guess the question we've all got to ask ourselves is it going to keep going down and then recover, or are we at the bottom at the moment? So that is the $1 million question, I guess, for many of us. And I want to ask you guys where you think we're at. I've got a poll here. So what will New Zealand house prices do in the next 12 months? Everybody would just hit the poll. And I wanted to run this poll early because you're going to hear the feedback from my community and myself, and then you're going to hear Tony's feedback. But I wanted your feedback unfettered before we do that. 12% of you think the house price is going to continue going down. 34% of you think that it will flatline and there'll be no change. 51% of you think that house prices will go up slightly, and 3% of you, the optimists, think that they're going to go up a lot. So that about says it really. They're either going to flatline or go up slightly. I completely agree with that. I also think that we are at the bottom for reasons that will be shared tonight. Next question for you, which is a big determinant of all of this, is do you think that interest rates are going to go up, down, or stay the same? So let's just answer that question. And this is a harder one to pick, isn't it? Because it's not just about what's happening in New Zealand, it's money supply overseas. We get 30% of our money supply from Wall Street and international markets, so it does affect us. So 20% of you think rates are going to go up, 28% of you think rates are going to go down, and 52% of you think rates are going to stay the same. Harder one to pick, but I'm with the 52% there. I think interest rates are going to stay the same. Very interesting. So it'd be interesting to compare that to what Tony's going to tell us shortly. Right, so I wanted to give you a bit of feedback from the community rather than taking my word for what's going on, in my opinion. Let's talk to people who are in the market, building things, lending money, selling houses. And so I did a bit of a whip around, and let's just start with Ben the builder. This is Ben Holwerder, who's a director at BH Construction. Small builder in Auckland, builds high-end houses, and a good builder, and I describe him as a strategic thinker. He's a clever man, Ben. So I said, Ben, what do you think's going on? And he said, commercial's going really well, residential's crashing. All of his mates in building residential are concerned because they've got work now, but they don't have work ahead to move to. So that's, Auckland residential. He said that 8 out of 10 of his construction proposals this year were rejected. And the feedback is that it's not price, it's interest rates and uncertainty over the election and just general market uncertainty. So everyone's keen to do the projects, they're just saying not now. He's saying he's having to work all over New Zealand to maintain his turnover. He knows that lots of builders are near to being out of work. He has a sister company in Tauranga, and he told me that Tauranga and residential's crashed, but commercial's standing up down there. So they're moving towards the commercial side. He said KO is a big influencer in the market and is still driving construction. I asked him about rates, and I said a lot of the builders, or a lot of the developers, myself included, are anticipating that in the next year or two, rates are going to go down as builders run out of work, and I still think that. He said to me that painters, tile layers and sub-trades had double what they charged in the last 3 years, and builders had gone up about 30%. So he thinks that there's margin to come out of the sub-trades and the building suppliers. So interesting. That was a builder's perspective. I haven't got a picture of Celeste on there, but I asked one of our chartered accountants here, Celeste Chand, who's my business partner in my property actually, and he said to me that the feedback from his client base is that KO is pulling back at the moment. Kangaroo are pulling back, and that a lot of people are reporting that projects they were doing with KO are being put on hold. Could be election jitters, or they could be out of money. Who knows? But that's a bit of feedback. He said that he had seen rents outside of Auckland going through the roof. That there's a major shortage of housing in areas like Gisborne, Rotorua, which I mentioned, and he's seeing massive increases in rents. And within the Auckland market, his feedback from the client base is that we're seeing a huge shortage of housing at the moment because listings are down to sell, and the rental market's very tight. So, by example, he cited a Flatbush house in Auckland. Flatbush is good demographic in Auckland. There was a 2-bedroom unit with a kitchenette, so it's not even a full house. It was listed. It got 6,000 hits on the first day, 300 applicants. And his client interviewed 10 of them and got $575 per week for 2 bedrooms and a kitchenette. So there's a major shortage of rental stock in Auckland and across the country emerging. He commented and said that consenting is up, and so supply should ease. But I have concerns, and I'd be interested in what Tony thinks. I have concerns that people like myself are consenting, but aren't necessarily going to start construction. I think a lot of this consenting activity, this recent consenting activity that's going on, is actually just people getting ready for the down market when builders reduce the prices. A lot of the people that are consenting are not actually intending to start their consenting, their build yet. They're just getting lined up for it when the market conditions improve. We're going to talk more about consenting later, so I'll leave that conversation. Slash made a couple of insightful points. He said that people are not listing properties because they're not able to upgrade their housing or get the same amount of finance that they've got to complete an upgrade on the house, or even to sell and repurchase. They can't get the finance back, so they're sort of locked into the house because the current market is testing on the new rates. And even though they can afford to pay them, they can't afford to borrow the same amount of money. So they can't list and sell and repurchase. That's locking them into their existing house. Also, investors don't want to sell for the same reason. They can't get the finance back. Our mortgage broker friends who also didn't make the list because I didn't get time to screenshot them, but Chris Bettison and Ryan Smart at KPM Mortgages gave me a quick download. They said that this year was better than they thought it was going to be, that there hasn't been the distress that they thought there would be. He said that they think that the interest rates have peaked, and that the Reserve Bank saying that they perceive them to be peaking has really taken put a lot of confidence back into the market. There are signs of finance relaxing, with the banks getting easier on their testing rates. Anecdotally, inside the lending teams, they're seeing the banks cut slack to the borrowers, and they're getting deals through that they couldn't get through earlier in the year. They're seeing Westpac drop their test rate, which is interesting. So, and that it's just one bank, but easing of the test rates, which is perception that there could be a drop in rates. They haven't seen much distress. There are people not coming to them. They're not the number of people coming to them in distress that they thought they would have. And they say they account for this because people were prepared this time. There's a lot more education in the market. And the banks are also they're using common sense. They're rolling people onto interest only if they're in distress. They're not forcing them onto P&I, which they've done in past property recessions. So that's a big change this cycle. And Chris also noted that with incomes going up, interest rates have gone up, but so have incomes, and we're at full employment. So that's reducing the amount of distress that's around. And they said that they are seeing a lot of first-time buyers and traders come back into the market, and so we've got early green shoots in a recovery, and they're seeing that there's a lot more applications coming into the market in the last 30 to 60 days. So pretty much their message was that there's a lot of common sense being shown by the banks, especially allowing people to stay on interest only if they're distressed. They also said that all of the silly questions that were coming from the banks as a result of those crazy triple CFA rules, how many cups of coffee do you have a week and do you have a spa pool, which banks were asking to determine your private costs, all that stuff's stopped because there's been some rationalisation done on triple CFA. I gave Steve Goody a call. Steve Goody's a property coach and I guess you'd call him a property influencer. He's a high-profile guy in the media and he's a smart guy. And he said he's seeing loads of activity. Clearance rates are improving. There's cash chasing property, which wasn't there last year. He doesn't think it's premature to call the bottom of the market. He thinks we're in recovery. He thinks prudential lending controls from the banks have done their job. So banks were testing at interest rates at 6 to 9% in the last 3 or 4 years and earlier. And LVRs were set at 60, 65. And so now when interest rates have actually gone up and property values have dropped, there's the capacity in the finance market and the property economy to withstand the impact of a rise in rates because the banks wouldn't lend to you unless you qualified for the money. So prudential lending control is doing their job and it's playing out. I think I had a discussion with Steve, the media are baying for blood. There's nothing better to sell clicks than people going broke and mortgagee sales and distress. And I think the media are distressed because there's very few mortgagee sales. There's something like 6 to 10 a week nationally. And we're just not seeing the distress. And that's because good prudential lending controls, and actually there's a lot of wealth in New Zealand and it's concentrated in property. So he said of the Wellington market that it's down close to 25%. Rents are pulling back from their historic highs. He said a new build, 2 bedrooms, getting $750 to $800 a week, and that's down $50 a week. He said the bottom end of the Wellington market is underpinned by students, and the students, the universities got soft demand at the moment. It's not full. The courses are not full, so the students are not back. So that end of the market is very soft. And he said that the reaction from the market is that everybody's just stopped listing. So listings are down. There's far fewer listings. And he said you can rent a house in Wellington, but you can't buy a house at the moment. So the Wellington supply is drying up because there's no listings. People are just sitting on their properties. They don't have to take the distressed prices, so they sit back. He said that people are not activating fresh consents, which I think is something we're going to see in Auckland. So he said that there's consents being applied for, but they're not building them, they're waiting. He said that the builders that have built lots of properties like Williams Corp that haven't sold it, being smart and Airbnb-ing it or renting it, and that's keeping them going. He said of the Auckland market that the thing he likes about auctions is they're very transparent, and the Barfoot's auction clearance rates have increased to 70%. And that's echoed on what I'm hearing from Ray White and others in the market. So, auction clearance rates are rising. Vendor expectation has receded is a big part of that. So vendors being realistic. Steve thinks that Auckland is the most undervalued market in the country. And Tony was saying that to me earlier, so it'd be interesting to compare Tony's comments on that. Steve tracks mortgagee sales, and he noted that there's only 30 to 33 mortgagee sales across New Zealand listed at the moment. And with there being no listings, there's a bit of FOMO around people saying, are we at the bottom? Are we going to miss the bounce? And there's a lot of people trying to get back in, but there's nothing to buy. Moving to the real estate agents. So I spoke to Adam Thompson at Ray White in South Auckland. So let's talk about the South Auckland market. And I spoke to his colleague, Charlie Brothers. And they said to me that home buyers are back in droves, that it was investors driving the market, now it's home buyers. And he said to me that the investors are being beaten by the home buyers will pay more. He said that South Auckland's now got pre-auction offers. We're back at that stage in the market and multiple offers happening. They had a property that they sold 2 months ago, 14 Boundary Road for 680,000. Somebody did a light renovation and it resold last week for 900. He just used that as an example. He said that they feel that the market has bottomed out and momentum is swinging back towards being a seller's market. He thinks this is happening because the Reserve Bank said that the OCR has peaked and it's costing more to build a house than you can buy it for in South Auckland at the moment. Last week, they had a big auction, 58 properties, 1 sold prior, 57 went to market, 38 sold, 66% clearance rate. Adam said that they see no further decline in the market going forwards, and that's kind of the general opinion of the market, that everybody is becoming active because they don't see a further decline. And that was a big factor for people, that people didn't want to invest because they perceived the market was going to fall. But now that's turning, they're coming back in. So Adam and Charlie are not expecting growth, but they do expect confidence to return to the market. They do expect a lot more volume and activity. And they're both saying clearly that we're at the bottom. So I then went to West Auckland and I spoke to Yingli Howe from Barfoot's out there, who's a very experienced agent. And she said in the last 4 weeks, supply has disappeared. There's not enough supply, that they have multi-offers, pre-tender offers. She said the market hates plaster houses and pylons. She said that there's been very low activity out west, but it's now recovering rapidly. And the OCR not increasing has been a big factor. So Ying's very confident that that market is in recovery and is seeing activity from home buyers and investors. I then went to East Auckland and spoke to Megan Jaffe Real Estate and John Barrington and Thomas Farmer, who are Megan's business partners in that business. And she said that clearance rates are remaining the same in Remuera, but on the improve. She said that people are waiting for the election result and they're apprehensive of the election, and that's pulling back on the number of listings that are coming through. And that has led to their auction, their selling rate to be 107% of their listing rate. That was a big number. So they are selling 107% of their listings. So people are not listing, and all of their properties that have been hanging around for the last 90, 120 days that haven't been selling are suddenly selling. So they're selling more than they're listing. So it's very interesting. And I think it was John Barrington said that it's the first time since 2009 that they're selling more than they're listing. So that's, a real change in the market. And it's a combination of old vendors aligning to the market and new vendors not coming into the market with election jitters. So recovery in central and eastern Auckland corridor, and a lot more activity, particularly from home buyers. Then I went to the North Shore and I spoke to Shane Coote from Ray White in Mairangi Bay there. He said listings are low and getting lower, multi-offers, auction clearance rates are rising, no huge price change, but prices are much firmer, and he feels you're going to get more for a property if you sell it this month than you would 2 months ago, but not a lot more, but they are definitely firming. He said that most buyers are talking about the election and their apprehension that there's not a change of government. He's concerned about the exodus to Aussie. Everybody says they're off to Aussie for better income and, change of government. They're not happy with the government, is the feedback. Buyers are not waiting, Shane said. Sellers are waiting. And I think that is a consistent theme from all of these agents there. The sellers are now saying bad time to sell, won't sell, and the buyers are coming in, feeling the bottom of the market, fear of missing out, and it's starting to heat up. So that is the feedback from the team, and I think it's calling the bottom of the market. I reckon we're at the bottom of the market. I'm not going to talk too much more. I'm going to start to bring Tony in, but I'm going to get political for a moment. So for property, and I'm going to stay within my lane, this government hates property investors. I feel that property investors have been discriminated against by this government. They're very, and I know that all the left-wing people will be laughing and coughing. That's fine. But, we've been labelled tax cheats. We've been targeted with rifle taxes through the likes of interest on deduction rules, which are just a rort. That's absurd to take away interest deductibility from investors. If you want to tax investors, bring in a stamp duty or bring in a capital gains tax, but interest on deductions is distortionary. It's really a capital tax when you haven't sold the property. So it's very hard to fund. And it has all sorts of problems. It pushes up rents because it just gets passed along. It makes it very hard for investors to stay in the market with second-hand housing. So investors start dumping their second-hand houses and buying new houses or trying to rort the system to get the deductibility by, using the exemptions available for those rules. So it's just distortionary and it's unnecessary. So if you want to change the government, I want to say to you, you've got to vote for ACT or National, because both of them are on record saying that they're going to withdraw these interest on deduction rules. And I want to point out to you that you shouldn't vote for minority parties. So, for example, if you vote for Winston Peters and he doesn't get 5%, your vote is wasted. Such an important election, this election coming up. So if you vote for Peters, he does say some good things. I like the way he talks. I don't like necessarily him or what he's doing, but he does speak very well. He's very articulate, and a lot of what he says resonates. So it's tempting to vote for a guy like that. But if he gets 4.9%, your vote's wasted. And I think this country really needs your vote this election. I've never been political in the past, but I'm furious with what has happened to property under this government. So I've become political. So I just want to say to you, vote ACT or National if you want your property to be rationalised from a central government's perspective. And you shouldn't vote for parties that are not going to get 5%, or your vote will be wasted if they don't get 5%. So that's all I'm going to say on politics this night. In 3 or 4 weeks' time, I've got David Seymour, possibly Nicola Willis as well. So we'll get political again then. But what I am interested in doing, and I made this picture up for you, especially for the webinar. I want to poll you guys, and the question is, do you think we're going to get a change of government? Okay, not do you want to change a government, because we all know what I want, and that's irrelevant. And you might have the same view of me or a different view. Doesn't matter. Do you think we're going to get a change of government in October 2023? So will the government change from being Labor-led? Bear in mind that the polls are 50-50 on this. And there's a lot of selection bias in this poll when you consider the picture I've put on the screen and the introduction I've given. But let's end the poll there. And 92% of you, a whopping 92% of you, think that the government is going to change. And that is interesting, because that's not, that's just me asking you rationally. So, I haven't asked you for your opinion. I've said, what do you think is going to happen? And every person I meet in the street, because I always ask people who are digging drains and on properties that I'm working on, average people in the street, I try not to be a person that asks people with the same political and economic backgrounds that I have that question. I try and ask people with different backgrounds. And everybody I meet says, I'm not happy with the direction of New Zealand. Yet the polls show a very different picture. I think there's something wrong with the polls in this country. They don't reflect the mood. And actually, if you want to put I'm sure you've all seen that meme. If you want to see a more humorous aspect of this, this is Sportsbet Australia, and their National's paying $1.45 and Labor's paying $2.75. So that's what the money is saying, and that is what your poll is saying. So I do think we're going to get a change of government. Interesting. TAB is paying something up. So if you ask a large group of people the same question, that the group tends to be smart and reflective of what's going on, apart from New Zealand polls. I really think we've got a change of government coming. Look at what happened on the Auckland election. The polls were 50-50, left and right wing candidates, and there was a big swing to the right on the day. So I think that's what's going to happen. That's my pick. Tony, are you with me?
Here I go. Definitely.
How are you, Tony? Welcome to GRA's property update and economic update. Thank you for joining us. For those of you that don't know Tony, he's an economist. He's also a bit of a property guy. He has quite a few houses, although he's not an investor. He tends to just like to own lots of houses for his family. He's GRA's favourite economist, and the reason why he's our favourite economist is he actually seems to get his predictions right. A lot of the other economists you'll listen to out there predict all sorts of wild and crazy things, but Tony's predictions actually seem to be very close to what the market does. So I personally have followed Tony for years. A bit of background on Tony. He graduated from Canterbury University in 1984 with a Master of Arts with an economics major, and he got first-class honours. He worked briefly in Sydney with Westpac and Wellington, and then joined BNZ, and then more recently went out on his own. He has 5 children. His wife undertakes research into early childcare, and he spends his spare time maintaining a lifestyle block in the north of Wellington. A couple of years ago, it amused me, he got into trouble with the PC Brigade for suggesting that young people should look at getting into the housing market and should think outside the square. He was lambasted on interest.co.nz and other social media sites for saying anything pro-property, because that's not cool in this country to be pro-property, is it? But he's good at picking what's going on in the economy, especially with housing, and he's very practical and property aware, so that's why we keep turning to Tony for advice and commentary. So Tony, welcome. I'm going to hand over to you now, and at the end of Tony's session, which will be about 45 minutes, we're going to have Q&A. Tony, over to you. Welcome. Thank you.
All right. Look, thanks very much for that, Matthew. Excellent summation of what's happening out there at the coalface. In fact, basically the best coalface, summary of what's happening in the housing market I think I've ever seen out there. Yeah, my father was a builder in Christchurch. We unfortunately lost everything, like the whole 14 acres, lovely house, unfortunately, with voluntary liquidation in 1978 when the house construction market was falling away. So it's always sort of been to the front of my mind there about the housing market can go through some big cycles, and certainly from the construction side can leave a bit of blood in the water, unfortunately, when that happens. I used to say with bio intros and things, my claim to fame was that I was on stage with Meatloaf at the Coogee Inn in Sydney in 1986. I've got a new claim to fame. I started off in 1985 at the Reserve Bank of Australia in the same intake into the economics department as Michelle Bullock, the newly appointed Reserve Bank governor. Now, I lasted 5 months. She's made 38 years. So full credit to her for sticking it out there at an institution I just couldn't stand in the end. But maybe that's my claim to fame now.
Hey, okay. Tony, I'm going to try and stop sharing the screen just to see if we can make there you go. That's better.
Okay, so just myself now. Rightio. Yep, and I see you. Rightio. Okay, so what I try to do in the housing market is, it's make predictions. Everybody wants a prediction about where do you think prices are going to go, all these sort of things. But for housing, as with the economy, businesses, etc., overall, often I'm just trying to pull people away from an unrealistically optimistic or unrealistically pessimistic view on the housing market. And I jumped solidly into this space in about October 2008 when we had an excellent digital journalist at the time say, well, house prices are collapsing overseas. They'll probably fall by 40% in New Zealand. And I thought, well, that's the last thing we need at a time when we're talking about a potential GFC, Great Depression, somebody to be scaring the bejeebers out of everybody. And I pointed out that New Zealand did not go into the GFC with excess construction of houses, as had happened in Ireland, the US, Portugal, Spain, etc. And so in the event, New Zealand house prices only actually fell by about 11% from peak month to the trough month there. And I left the BNZ there almost exactly 4 years ago, had a rest for 2 weeks, started writing a weekly publication. People were signing up to the thing. The first lockdown came along in March of 2020. I had 2,000 people signed up for the free weekly. 7 weeks later, there were 10,000 signed up. And I thought, okay, I guess I can make a business out of this and let's start surveying people. So I like to supplement the overall, macroeconomic analysis and what are the REI and Z data showing, what's the Reserve Bank saying, the Stats New Zealand data, etc., with surveys I do of my subscribers, who now number 31,000. And back then I started up 2 or 3. One of them, of course, is of real estate agents. So each month I'll survey real estate agents all around the country. I'm asking them, are they seeing more or fewer first home buyers, investors? Do they see FOMO? I've got the only measure of FOMO in the country. Do they see FOOP? I don't call it that, fear of overpaying. I ask them, what are buyers concerned about at the moment? And one of the options, of course, is they're worried that if they buy, they're going to look silly because prices will go down. And then I ask them, are they concerned about their incomes and access to credit, interest rates, all those sort of things. So there's a lot of information you can get from yourself for yourself by looking at that survey. I also survey mortgage brokers. I do a survey of residential property investors. That's with Crocker's Property Management, jacked up with them. And then another one from people as consumers, you and I, buying stuff at the shops, and then one of businesses I do as well. So I'm going to refer to some of those pieces of data along the way, but like I say, what I do when I'm speaking is I'm trying to drag people away from unreasonable views on what's going on. And a way to do that, I guess, is sort of to tell a story and make people understand what's happening and why things are happening. Often people go to extreme negative or positive views because they don't understand what it is that's going on out there. So I use my surveys, other sources of data to try and inform people about what's happening, maybe inform about what the factors will be in the future, but you still got to make your own mind up about what's going to happen. Because one of the lessons, hey, I learned this many years ago, and many others have learned this most recently. When it comes to forecasting asset markets, share markets, it might be commercial property, farmland, or whatever, because of the role that's played by people's sentiment of feeling happy, sad, wondering what other people are thinking, etc., you can get some fairly strong movements, and predictability is nowhere near as good as you think may be the case. Often you'll be talking in terms of cycles. I can remember for a long time people talking about maybe it's a 7-year cycle in Auckland. Some people say 10 years. Well, just for your guide, one of my publications, it's a paid one called TView Premium. You got to pay $150 a year to get it. I actually put in the issue I sent out about 7 hours ago, each Thursday there. Graphs starting in 1962 showing the annual change in house prices for New Zealand overall. And as I was doing that, I realized somewhere in the depths of this Excel spreadsheet I've had for years, I actually had the data also for Auckland and for Canterbury. So I've also got graphs from 1962 for the country, Auckland and Canterbury. Sorry about Wellington, I haven't got, for some reason, got the data in there. And you can see the peaks and the troughs, and you can start to make your own analysis of this one seems to have a 7-year cycle. Here it seems to be 8 or whatever. So what do we got happening in the market? I thought the summary by Matthew there was pretty darn good, essentially, with the overall, of course, I guess, view perspective coming through that the housing market, not construction, but in terms of turnover, residential real estate and prices, has bottomed out. Now, I think we can feel reasonably safe in saying that because the view in Australia is they bottomed out in February. The view in Canada is they also bottomed out in February. I think when eventually we can sort of look back and smooth the data a bit, we're going to say March, April, maybe that is when things are bottomed out. And we can look at some data to get a good feel for that. REI and Z turnover, seasonally adjusted, showed about a 20% increase in sales in the June quarter. We're not going to continue at that and end up with an 80% increase in the year. So, these things don't go smoothly. But when you hit the bottom, sometimes the bounce up can be relatively strong in the turnover. Also, we have been seeing average falls each month in prices for the country as a whole from December 2021 through to about 3 or 4 months ago, averaging about 1.1% or so a month there, maybe 1.2%. But prices were basically unchanged in April and May, and nationwide seasonally adjusted, they improved about 0.7%. So, I wouldn't rule out that we see another month that's a negative, but I think we can say that prices overall have bottomed out. And I can also look at some of the data there in my surveys and see the improvements that are underway there. So I'm just going to run through some numbers here, and I might do more than just cover New Zealand. I might mention Auckland every now and then as well. So for instance, FOMO, the proportion of real estate agents saying buyers are worried that if they don't pull finger, they're going to miss out on something, that peaked at about 92% late in 2020. From the start of 2022 until, well, basically 2 months ago, it went from 4% to 9%. I'm surprised it wasn't zero, quite frankly. Now that reading is 19%. So nationwide, 19% of agents are saying there's FOMO. That's still very low, but I think that's going to rise relatively quickly. Auckland is at 27%. Wellington is 28%. Canterbury is 24%. Something interesting there. It's the big cities. I have a view that although the regions are still going to be well supported, I'm not going to sort of poo-poo on them at all, but there are elements of catch-up to be done. Christchurch, there's still some post-earthquake catch-up left. Wellington went through the roof, down the toilet, and there's a bounce back there for a few reasons I'll talk about. And Auckland, yeah, I've been pushing this line for a while now, that while Auckland is still very expensive dollar-wise, when you look at the trends of Auckland prices versus the rest of the country, Auckland is underpriced where it sits in the cycle at the moment. So yeah, Matthew made mention of one of the analysts there having that view, and I've got the view as well. So FOMO is starting to come up. FOOP, fear of overpaying, FOOP, that one is in fact coming down. And if I find my column on that one, I haven't got it. Basically, it was about 2 months ago for the country, 65% of agents saying, well, people are worried they'll buy and prices will go down. Now that's only 39% worries about that. The country as a whole is still in a seller's market. These data are 4 weeks old now. I'm going to send out the next survey to agents tomorrow. I think I might do it. A net 8% of agents still saying that the buyers have the upper hand in negotiations. So 4 weeks ago, we were still in a buyer's market, not Auckland. Auckland 4 weeks ago, 4%, net 4% of agents saying actually it's the sellers that have the upper hand. So Auckland already in a small buyer's market. Wellington and Christchurch still small sellers markets out there. Now, one of the things, of course, that's going on, and Matthew mentioned this a great number of times, is the availability of listings. I don't think we should underestimate what the impact will be, especially in 2024, of a relatively low number of listings. And the reason why I've been sort of jumping up about this one for a while is because of what happened in 2021. Early in 2021, we saw the LVRs return, and then they were strengthened for investors from May of that year. We saw the March 23 announcement about the tax changes for the investors as well. We saw migration going negative also, and we saw the interest rates, the fixed rates, starting to rise about June of that year. The market calmed down a bit. FOMO went from 90% down to about 50% or so, and then it shot up again. Over July through to November 2021, house prices nationwide on average rose by another 11%, despite all these negatives out there. And I've looked at it, everything, and I thought, why on earth did the market take off again? Why did FOMO go from 50% of agents seeing it back up to 70% in sort of August to September? There's only one thing I can find, and that is that the number of properties listed on the market for sale in New Zealand fell to a record low since 2007 data started in about July of 2021 of 13,500. People simply couldn't find anything to buy. And because prices were still rising at the time, that FOMO just took off again. The market was rising. Oh, okay. So in the second part of 2021, prices jumped up anew despite 5 negatives because of a shortage of listings. What's happening now? The stock of listings at the end of June nationwide sat at about 25,500. Yep, okay, 25,500. So you go, oh, right, that's quite a bit higher than 13,500 back in 2021. Yes, it is. But here's the issue. The number of listings has already fallen, seasonally adjusted 14% from the peak back in December. And it was only earlier on this week, I thought, when I was writing my weekly column for One Roof, maybe I'll have a look at what the regional numbers are, because, you know, it can get messy going down to the regional level. There are so many pieces of information to keep track of. In Christchurch, or Canterbury more accurately, the number of properties listed for sale peaked actually in March this year and is down 10%. Okay, yeah, it's falling away. Auckland peaked in August last year. Listing numbers are down 18%. Wellington listings peaked in also August last year, and the numbers are down 44%. Hence the article in the newspaper over the weekend of traffic jams in, I think it was Newlands, with every man and his dog showing up for open homes, a viewing there for a place to buy in Wellington. There is a shortage of stock out there. And I think this is something which, once people start to realize it, things get going there, it is going to be driving a bit more of a feeding frenzy. Not yet. Pre-election, honestly, there's just so much caution and uncertainty and nervousness out there. But at some stage, remember those three words, because I've been emphasizing them for quite some time for a number of things. At some stage, people are going to realize, I used to be able to choose or pick and choose, peruse, daydream about 3 properties. Now it's down to 2. If I leave things much longer, there might only be one option. And then after that, it's going to be some asbestos-laden fibro shack, which maybe we're going to have to be thinking about taking out a big mortgage on or so. So that one's going to be interesting. Why has the market improved so far? I've got just a little list here, and Matthew's already covered some of the factors. One, because people can now, I think, feel the worst case scenario of where interest rates are at, and probably not going to get any worse. 2 months ago, we had the banks in Australia starting to cut their stress interest rates because they felt, we think we're near a peak here. Why should we keep testing 2-3% higher over here? So they started to cut, and I expected we'd see at least one of the banks reducing stress interest rates here. And I'm pleased to hear that that is starting to happen. So seeing the worst case scenario for interest rates is bringing a few people forward. From a macroeconomic perspective, the unemployment rate's only 3.4%. In all previous recessions in New Zealand, when the economy starts shrinking, technical recession, whatever, job numbers go down. Not this time around. December quarter last year, our economy shrank about 0.6%. We shrank about 0.1% in the March quarter. Job numbers have increased about 1.3% over that period of time. We've not seen that before. So people feel good job security and feel, well, okay, I've got a job. If they lay me off, I can get another one relatively easily. We should be thinking about finally making our home purchase. Also, on top of that, the market's been sort of, falling for a while. People haven't been buying, maybe haven't been able to spend as much as normally. They've been building up their savings. So more people have 15, 20%, 25% deposits than was the case previously. So also, we've had prices simply come down. So people are doing a comparison of prices versus incomes, and things look better out there. And credit supply has also been improving with the tweaking of the LVRs, tweaking especially of the CCC FA there. And also something else. About 5 months ago now, things were looking okay, not too bad out there. Some of the banks started to discount their interest rates. You might recall for a brief period of time, BNZ had a 1-year fixed rate at 4.99%. It was actually less than it cost them to borrow the money. Now, I've no doubt at all that the Reserve Bank probably got on the phone to them and the other banks who were also introducing discounts on their rates and saying, this is not particularly helpful. We're tightening monetary policy with more to come. And the way we tighten monetary policy is we make the cost of you of borrowing money go up. So you have to put up mortgage rates. So people's spending gets crunched and eventually inflation comes down. But it's not helpful if you're cutting interest rates. So I feel maybe just a quick, polite conversation meant the banks did not repeat at all, that discounting we saw. It must have been around February or March. Instead, we have seen just little bit by little bit, even without the triple CFA and LVR tweaking, banks just making the credit a bit more readily available. Not so much to the investors, but definitely to the first home buyers out there. So a bit more less obvious, because after all, it's not as if you can pick up a newspaper or a publication and see exactly what the lending criteria are for any financial institution out there. So we've got these factors in place so far. They've contributed to, and I can tell from my surveys, the first home buyers coming back into the market from February, but not the investors. There's less negativism from the investors. So when I'm asking the mortgage advisors, you're seeing more or fewer investors, and the same for the real estate agents. So there's less negativism, but it's still net negative on the readings there. This so far has been driven by the first home buyers. I can tell from my monthly survey of consumers, which doesn't capture too many people 30 years and below. So it's mainly when I'm asking about housing, these people probably already own a house. There's not yet a big sign of the owner-occupiers deciding I'm going to sell, buy, or buy, sell. That part of the market, maybe 50% or so relevant to the real estate agents, not really chugging along as yet. And of course, not so much on the investment side as well, certainly for those that have a model dependent upon debt, which is what all the books on the bookshelves, of course, have been saying to people in New Zealand for a great number of years, that, you know, that's the method to use. Where do we go from here? Well, this is where it gets interesting. Now, early this year, I replied to a poll request from Reuters. And they do this, it looks like, about every 3 or 6 months. And they asked me and about 13 or 14 other economists, et cetera, in New Zealand, where did we expect house prices would go in New Zealand this year? Now, everybody reported that they expect house prices to fall this year, except me. I said, I think maybe they'll go up 3%. And it was so weird. They actually got on the phone to me from wherever they're based. I think it was across in London. I'm not quite sure. And they said, you're the weird one here. Why the hell are you predicting house prices will rise by 3% when everybody else is saying that they're still going to be falling come the end of this year? And so they said, we better do an article on this, an interview. So I ran through some of the reasons, some of which I've already mentioned there. I'm going to run through some of the possibly more important ones now. But I just wanted to take this opportunity to say that there is a shifting in the general view, the commentary that you see out there with regard to interest rates. The Reserve Bank themselves said it in their monetary policy statement of late May, that house prices haven't fallen as far as they thought they were going to, and don't look like they're going to go down. And actually, they've now reached sustainable levels anyway. There was HSBC, I think it was yesterday or the day before, noting they expect house prices to be rising. One report said at a 5% rate come the end of 2024, not this year. The article today said 5% in total over 2024. I'm going to choose to think they said 5% in total over 2024. I think it's more likely for the country to be 10% plus over calendar 2024 if I have to lay down any sort of a number on it. And this year, maybe it's 3 to 5% that the prices are going to go up. And I'm going to run down some reasons here behind my thinking, why I have a view that even the comments that Matthew was saying from the real estate agents of, oh, the activity's picking up, we expect it to pick up more, but, oh, no, there's not going to be a big increase or anything in prices out there. It's so politically incorrect to be giving that view out there. Well, I was prepared to do it a few months ago, so I'm going to stick with that. I think people are going to be surprised with the improvement in prices over 2024 in particular, and for a number of reasons. Now, one of them, and that I've mentioned already there, is interest rates peaking. Well, of course, interest rates are likely to be falling over 2024. We can see in Australia, the inflation number has just come out lower than expected. We see the Federal Reserve saying maybe only one further increase in their cash rate is likely. Internationally, the supply chains are functioning a lot better. So it's looking like the back of high inflation has been broken. That's not the same thing as saying when you go from 7% to 4%, it's easy to go down to 2%. There's still a worry that next year the story will be, oh, bugger, we're stuck at 4% or something like that. So don't for any second at the moment be believing the inflation battle is over and she's all going to be sweet from here. I don't think the interest rates will be falling rapidly over 2024. Our Reserve Bank has penciled in their first cut of about October next year. Most of us are thinking probably before the middle of this year. next year. And so you could start to see some cuts in the fixed mortgage rates late in this year. And of course, there are so many people at the moment who would love to buy, who recognize that they've had a window of opportunity to make a purchase with vendors willing to negotiate, no great competition from others in the market, but they haven't been able to because they can't meet the stress test. Well, as the interest rates start to come down, each stepping down will bring more eligible buyers into the market. So the interest rate falls over 2024 and 2025. I think a person would be a bit silly to really start putting any great numbers on that. There's too much uncertainty, but it's clearly going to be a stimulatory factor in the market. So at some stage, the mortgage rates start coming down. At some stage, people are going to realize new house supply is drying up. They don't. There is no great discussion about that at the moment. There is certainly discussion in the media about the financial disaster which has befallen some people who paid their deposit 5-10% or whatever it was 12-18 months ago. Now the place has been completed, but they cannot get a bank to lend them the money because they still have to pay $1 million, but now the place is only valued at 800,000, and some of these poor beggars are going to be losing the entirety of their deposit. So it's an absolute disaster out there for some people. And when people see stories like that and they see projects half finished and people losing their projects because the builder's gone under, for a great number of months now, that's just made people go, no way, Jose, I'm not going to touch a new build with a barge pole. I will look at an existing property. So there's been that dynamic in play, but people haven't extrapolated that to thinking, what does it mean for the quantity of new builds coming along? Well, as Matthew's been pointing out there, the consent numbers have been strong. They peaked at a record annual number in the year to May last year of 51,000. We're down to about 45,500 now. But it was always the case all the way along. Nobody really believed all of those places were going to get built. And B, the consent numbers are going to be falling away quite quickly from here on out.
Hey, Tony.
Sorry, Matthew, go for it.
Can I go to there and just say that the planners that I knock around with and talk to are telling me that they are inundated with consent applications to process.
Yep.
And that's last 60 days. Suddenly, all the developers are consenting. So it hasn't hit council yet.
Oh, okay. Oh, well, that's interesting. That's the first time I've heard that feedback. I had feedback that there was an upward bias in some of the consent numbers ahead of May 1.
It's Auckland. It's Auckland, yeah.
Yeah, you've got the new insulation requirements, and there's some more coming along later on this year, I think in November as well. But
so I was interested in just supply versus demand, because that's something that's helped me invest across the years, as I pick areas where supply is tight for whatever reason, and people are moving there. So what do you think is going to happen with immigration? And what do you think is going to happen with consenting?
Yeah, well, that's another interesting thing. You see, for the moment, people in the dinner parties, conversations at the bar, it's all about, I got this mate and he's already left for Australia. My brother's going to go. So that's where our minds are focused at the moment. People aren't really focused on the fact that we've got all these other people coming in from the rest of the world, predominantly Chinese, Indian, Filipinos, South Africans, etc. And the net migration gain for New Zealand, which I wrote 7 or 8 months ago, I think this year we'll have a net gain, maybe 15 to 20,000. Well, we're at plus 78,000 in the year to May. That's a 1.5% boost to our population. And I can see in my monthly survey of residential property investors, this is having an impact on the market. In my survey back in December last year, a net 8% of the investors said, oh, it's relatively hard to get a good tenant. Now a record net 17% are saying it's relatively easy to get a good tenant. So there is extra demand for rental property at a time when, yep, there's some new supply, townhouses, etc., coming on the market, but also some diversion of supply going into foreign students, and of course the Airbnb market for the surge in tourism over the past year as well. So what happens is the net migration initially boosts the rental side of the market, and then if not the migrants themselves, the next people up the chain, there up the ladder, they move into home ownership. There's no great discussion about this yet in New Zealand. There is in Australia with record migration of 400,000 in the past year. That will come along. And this is where it's significant, I think, especially for Auckland. Migrants go where migrants have gone, and migrants traditionally go to Auckland, but with a good spillover also into the likes of Wellington and into Christchurch as well. So I think Auckland will be sort of the major beneficiary of this population surge. But there is a different dynamic. Kiwis are leaving the country in increasing numbers, going to Australia. Kiwis leave from everywhere, not just Auckland, Wellington, Christchurch, but Eketahuna, Riverton, Westport, etc. So there is a redistributional population thing going on here that says to me, apart from particular areas like Rotorua has always been one of the most interesting markets over the cycles that I've sort of seen there, I have a concern that for some other regions around New Zealand, they'll be losing Kiwis, but not getting the same migration burst extra as the other cities there. And during the pandemic, I have a view that a lot of people who might have been going to cash up in Auckland, wherever, sell, free up cash and move to Havelock North, Hawke's Bay or something like that, have already done it in late 2021, 2022. It gave an extra boost to the populations in those areas, Manawatu, Wanganui, for instance, and there's a possibility that construction reacted good for the population surge, but there could easily be a temporary period of the construction coming on is exceeding the actual growth in the population for the moment. It's just a theory, and clearly it doesn't apply for the moment in Rotorua, but I do think this is going to be a cycle which is not going to be the regions really having the greatest strength, which was the case from late 2016. It is going to be a bit more city-based there. And that's one reason I read through those numbers there, that you look at the averages on, like I just had on the FOMO, the country's 19, but Auckland, Wellington, Canterbury, they were all around 24 to 28%. So that's sort of some of the regional analysis that I do there.
It's funny you say that, because not all regions, but some of the regions that we're tracking, like Gisborne, for example, are really tight. There's just no rental property there, and there's insane rents being paid. So, another comment I wanted to make is the migration data has changed. It used to be intentions-based. The migrant would tick an arrival card and say, I'm going to move to Auckland.
Yep.
They would then sit in the Pullman Hotel, buy a house in Tauranga, move to Tauranga, but the stats would show that Auckland got the migrant. And so Stats New Zealand changed, and they changed that data, and they said, we're going to run outcomes-based data.
Mm-hmm.
You know this, I'm just saying it for the group. And so they then started to look at what happened to a migrant after they described a migrant as somebody who'd been resident in New Zealand for 12 months. And so
12 out of the past 16, yep.
And so then at the end of that period, they would count the migrant, where they moved to, by looking at IRD data and health data and so forth, and get a much more accurate analysis of where the population is actually moving. So in theory, we have a much better quality immigration picture. But I'm very suspicious of it, because the data is 12 months old before they report it, and then they have to update it. So if you get a big movement that's outside the average, they don't know for a substantial period of time, and then they can smooth the data and update it. And I'm just suspicious of it, right? Because I feel like there's a lot of people leaving the country to Australia.
I wouldn't pay any attention to the regional migration data. I don't actually think they do produce it. I've not seen any of it on a sort of regional basis out there. And even though I can see that pressure in the rental market from the accelerated population growth, it's not as if it's all occurred suddenly now. What you have happening is people who have arrived in the country sort of 16 months ago have spent at least the past 12 of the past 16 months in the country, and they get reclassified from short-term visitor to a permanent and long-term migrant. And so it does give an upward bias to the numbers there. But it does mean generally more people are sloshing around the economy, but not necessarily all arriving just quickly at this period of time. Yeah. My point of view is that at some stage, people will realize that we're getting this population surge at the same time as construction is falling away, which I expect it to do over the next couple of years, especially for the multi-unit developments, because that's where you need the pre-sales, et cetera, to get the finance from the bank. And historically, when we get the housing cycle going up and down, everything goes down together, but the proportionate decline in the multi-units, the townhouses and the apartments is greater than for the standalone houses. So, there's just going to be some greater weakness there. But Whereas, previously I might be thinking, I guess this lasts for 2 to 3 years. Well, given the housing demand that sits out there, KO's role there, the population growth, I don't think it's going to stretch out for that period of time. It might be an 18-month thing that we see the construction falling away, and then an upturn maybe from some point in 2020-25 on that. The other ones I just wanted to note in there, so I'm saying at some stage, people are going to realise there's a migration surge underway, and they'll remember what that's done in the past. People used to talk about that for Auckland in particular. The interest rates going down as well, that new build supply easing off. And then there's two other factors, of course, the listings falling away. I think that's going to be surprising people. They've got used to being able to just sort of go online for real estate pornography and have a look at what's available and look at site it, all these sort of things, 3D, walking around it. And the opportunity to do that is going to die away. And the lesson of 2021 second half is that quantity of listings matters. Historically, when sales pick up, more new listings come forward, but more buyers come forward than vendors, and so the stock goes down. And I think one story for 2024 is going to be some surprises on the availability of stock, and Wellington at the weekend might have just been a little early, I think too early, tendril of that. And let me just say that the final thing, of course, is the election outcome. Every data series I've got shows investors backing away as buyers, not stepping forward as sellers, but backing away as buyers from, well, when it became effective, March 27 of 2021. So presumably, if we get a victory for National, and then we get the restoration of interest expense deductibility, I would expect the investors to be stepping forward again, also encouraged by the interest rates starting to come down, a focus on the migration numbers. And also just the final comment I'll make there is, and I might have briefly mentioned it earlier on, a lot of people they stood back from the market from early 2021 because there was nothing to choose from. And then they couldn't get the credit, and then the prices were falling. There's a 2.5-year queue of buyers. There's a similar one of smaller magnitude, I'd suggest, for vendors, but the one of buyers tend to be the one that does the big moving. And at some stage, that 2.5-year queue or stack is going to get activated. I don't see it ahead of the election. I think getting into summer still feels a bit early, but I think for next year, that is going to likely be the case. So that's the position where I'm coming from, and I think people are going to be surprised by the strength of the return of the market, mainly next year, post-election. But of course, if you're looking at this for the long term, and that's what property investment is all about, this sort of timing of 6 months or 9 months or whatever, it doesn't really matter. I can assure you, none of us has the ability to pick the bottom of the cycle or the top of the cycle. And the worst mistake you could make is thinking that you can, and maybe you're holding out for it and you end up chasing it, on the way down when, say, you're looking to sell and the buyers have disappeared. So your timing was very good there, Matthew, even though you weren't selling at the peak in the cycle. I'm out there published as saying in about February of 2021, well, this at a minimum is when you sell your crap, because there's still a frenzy of buyers and the skilled investors that have been around for generations. That you step back from the market and you sell when you're still getting good prices and not having to spend untold on advertising.
I dumped a bunch of stuff in 2020, and then I was astonished that it went even higher in 2021, so I dumped a bunch more.
Yeah.
And then I couldn't believe what I saw in South Auckland. I saw houses that I sold one for $950. And it got resold at 1.35 4 months later.
That's amazing.
So I felt stupid. But it's not worth 1.35 million, I can tell you. And today I reckon they'd get 850, 900 for it. So I just think that New Zealand went crazy in 2021, drunk on liquidity from the Reserve Bank and cheap money.
Yep.
And I'm sort of tempted to say that the housing market is almost speculating on interest rates.
It could be wrong. I mean, none of us have got a good interest rate forecasting record.
Yeah.
Since 2006, quite frankly.
It's directly correlated to money supply and the price of money.
Yeah. Yeah, well, certainly the price of it, and the credit rules have done New Zealand good. Even before the GFC, we didn't have a collapse in the housing market. And of course, we're not seeing a rush of mortgagee sales because we've had the LVRs for a great period of time. And so when the debt to income ratios come in next year, May or whatever the timing is going to be, it's not going to be in an environment where lending by the banks has been quite bad into the housing sector. So we need this thing to be sort of crunching back and reducing the risk. The Reserve Bank has stated quite firmly that they're very happy with the risk exposure of the banks in the markets there. So when the DTIs come in from an overall housing market impact point of view, it'll exercise a little bit of restraint, but I don't think it's just going to be, oh, bang, it stops it. And people should just remember that with the LVRs, with the stress tests, with the DTIs, with the capital requirements for banks, the focus of the Reserve Bank is not on controlling the pace of change or level of house prices. They might have a view, but they're not looking to control house price inflation. It's bank lending risk backed by housing. That's their focus, not the house price inflation for which they don't have a target at all.
Tony, there's something interesting there. The English model looks at household income, and they look at your debt on your household income and they exclude the investment debt from DTIs. I think that's the way it works there. In New Zealand, they're taking all of your debt and bringing your investment debt in. And I look at that and think that could actually be severely constraining to investors. I'm worried about that. I'm going to discuss this with Chris Peterson in a couple of weeks because he's doing some work on it. But do you know anything about the difference in the two regimes?
I don't know all that much about the British regime. I mean, I'm aware that I think they're running on a ratio of 4.25 or so times income is the maximum debt that you will be allowed there. But as an accountant, you'll be all over the extra detail in terms of what's included in and what's included out than myself as an economist ever will be. I know the Irish, they eased up on there. I think they had like 3.5 times ratio. People have had a guess for New Zealand of maybe it's 6 or 7. The Reserve Bank has done research showing or suggesting that the greater impact will be on the investors and not really on the first home buyers in New Zealand when they bring in the DTIs. If they think it's going to have too much of an impact, they may actually choose at the time to ease up on the LVRs.
I think it's a real concern because if you earn an extra dollar from rent and you pay an extra dollar in interest, all of the income goes to the investment. Mm-hmm. In a household, if you earn an extra dollar, you're paying for your household living costs. It's a totally different dynamic. Mm-hmm. Your cost of your house is one portion of it. So to apply one ratio across, private expenditure in your private home and bring in your investment expenditure, it's not right because if, for example, you buy a rental property and you're earning 8% as a net yield and your cost of funds are at 7, then you're +1. You're actually making more money. Mm. But then say, well, you can only have 6 times your earnings. The ratios get out of skew, and that is actually restricting investors from becoming larger. And that's my concern is for existing investors, something they're unbankable because DTIs take them out of the market.
Yeah, and that could easily be the case. And of course, the government's going to have to keep a close eye on this because 30% of the population in New Zealand is renting, and the government, as we've seen, does not have the capacity to provide decent rental accommodation, even for people who you'd think would be sitting in state houses there. So they need the private sector. So I've no doubt they'll look at what impact it'll have on the overall provision of rental accommodation. Of course, this is a major concern across in Australia, where there's shortage of rental properties as well. They've had less construction than New Zealand in recent years, so it's a slightly different dynamic.
80% of rental stock is private, mm-hmm. 20 is state. So, and of course the government were going to change this. They were going to build 100,000 houses and they've built 1,800.
Yeah, still waiting.
So I think they've discovered that it's not as easy to build houses as they thought. But I don't think they've learned that the private sector are so important in providing that housing stock and maintaining it because they're not looking after us.
Yeah. No, well, certainly they'd rather either minimise the role of the private sector in the housing market or the economy generally, or control the private sector, make it an instrument of state. Who knows, rent freezes they're looking at overseas in the state of Victoria, this sort of thing, for instance. So there we go.
Right. Well, I think that's an excellent summary. So your view is interest rates are going to level off and stay flat or go down?
Most of us have been saying since the middle of last year, we think this is the peak. We've all been wrong. Surely this time we're going to be right. That's all I can say.
Okay.
Surely this time we're right, and we're saying that after the most recent round of fixed rate increases of about 0.2, 0.3%, surely this is as high as they are going to go. I do get the feeling the banks have been sort of taking advantage of a window of opportunity to get increases in, even without the official cash rate changing, because the dynamic might shift on them a bit further down the track. Once the Reserve Bank makes a comment of the outlook is okay, the easing may come sooner than we're expecting, the window maybe for the banks to sort of try and recoup a bit of margin could just be gone. But I think we're at the peak now, but I do caution people not to place high reliance on anybody's forecasting of the timing of interest rates coming down or the speed. I could spend the next 10 minutes here running through a list of things that make this one of the most unique, unpredictable environments we've ever seen. And I'll only mention one of them here. 3.5 years ago, we get ourselves a pandemic. We all made forecasts. Every single one of our forecasts was wrong because nobody has ever lived through, back then, a pandemic before. Now we have. We know what's going to happen. Well, right now, we're in a post-pandemic environment. None of us has lived through a post-pandemic environment before, and no miracle has now given us an ability to accurately predict what's going to happen that clearly we didn't have 3.5 years ago. So there's other factors in there, but predictability remains relatively low. So, that's why there's still value, in the likes of, say, even 2-year fixing of one's interest rate. 18 months is quite popular at the moment. 1 year is relatively expensive, but to have it all sitting there in a belief in whoever's predicted that interest rates start falling sharply from May next year, that just seems it's taking a little bit of a gamble, quite frankly.
Okay. Well, tonight I've heard you say that we're going to get 3 to 5% growth this year, 10% next year. And because interest rates will fall in 2024. And I don't know if we'll get that much growth, but I agree with you on I think that the market is slowing down and the Reserve Bank's going to take the foot off rate rises, and there's more downside than upside. That's my feeling on it. So where are you on immigration? Immigration's going to stay high, or what's it going to do?
Oh, there was an unusual surge February, March, where the monthly number seasonally adjusted was about 12,000 each month. We've now settled down around about 4,000 to 5,000. So even if we said 4, then in a year's time, we might be looking at a net migration gain of around about 50,000. And we averaged in the period from 2014 to 19, about 55,000 per year. So maybe we're going back towards the firm population growth of 2014 to 19, which did contribute to the housing market going up. And people should just be aware that, there's a migration surge in New Zealand. There's exactly the same thing happening in Australia, the United Kingdom, Canada, United States as well. We're not unique in tightness of labour market and an unusual migration surge. It's happening elsewhere.
And we need these people, but the crazy thing is that we don't have the housing for them.
Yep.
Let's go to Q&A. Here's one for you, Tony. What happens to the real estate sector if Labor, Maori and Greens win the election?
Yes, you see, I hadn't dared sort of go down that route. I have at some of the places I've been speaking recently. I had 3 talks, presentations in Christchurch yesterday, and I had a one up in Christchurch today. Well, that's the horror scenario, isn't it? That we know a major party will whore themselves to whatever extent is necessary to get or hold on to the reins of power. And so the horror scenario is the only way Labor can basically occupy the benches still is if they form a coalition or support whatever with the Maori Party and Greens. And in sort of a fit of desperation there, they agree to start implementing some of their, wealth taxes or something like that. That's the horror scenario. I give it a low probability, but it's enough of a probability to make me think most investors are still going to wait to see the reality of this before they will necessarily step forward. What do you want to do? Lay down the money, take a punt that there's going to be a tax change and you're wrong? Well, that could be expensive.
Mm-hmm. Somebody says, how does somebody with a debt of over 10 times their income already keep investing with DTIs coming in? Will we give up?
They wouldn't make it retrospective and make you give up the debt and force sales. No, so they would, what's that, grandfathering or whatever. You just wouldn't be able to borrow new. But hey, we've seen that anyway. over 2021. You couldn't get any new money as an investor anyway, with the LVR, the minimum deposit. We went to, was it 40% again in May of that year? And then as we approach the November LVR tightening and triple CFA, etc. So we've sort of been in a version of that before. It's a question of, I remember back at the time, will the banks get forceful to say, we do want you to improve your ratios out there? I don't think that pressure would really go on to say, no, you got to get this down to 6 to 1 or something. I'll be surprised.
Chloe said that I mentioned picking areas of short supply. How do you work that out? And what I've done in the past, Chloe, is I've graphed consenting by area against immigration by area, because Stats New Zealand have published in the past what's happening with immigration by area, and with their new outcomes-based approach, that would be a better quality statistic, and that is pure supply versus demand, and it reveals that some areas are just very, very tight. Tauranga, and Tony, I don't know if you're aware, but Tauranga's crashed for construction.
It's done this before in its cycles, has Tauranga. It goes up strongly, the prices rise, through the roof. People would talk about, just back from Papamoa, and then all of a sudden it sort of reaches a price point where people just can't sort of buy them any longer, and it goes down on the other side. It's got the same sort of challenge as many other parts of New Zealand for the CBD area, of course. Auckland CBD, oh dear. Wellington, Christchurch looks quite good for your guide, and maybe that's why I am now doing almost as many presentations in Christchurch at Te Pai, the new convention centre, frankly, as I'm doing up in Auckland. There's just an interesting dynamic for People's Guide. I remain firmly of the view there is internal migration still to happen to Christchurch. There's a double catch up on tourism, because just as they were getting the post-earthquake catch up, the pandemic came along. So that's to come along and benefit them as well. So I've got sort of just a bit of favoritism towards Christchurch, but also Wellington. It's interesting. Yeah.
It's a longer conversation than tonight, but I totally agree with what you're saying. Liz says, if you wanted to sell and not be stressed, when would you list, and what method of sale would you use in this market?
I don't know about method of sale. Just talk to a real estate agent, because different parts of the country, auctions work better than other parts by negotiation or whatever. So you definitely talk. And of course, the thing with property is you hold on as long as possible, quite frankly. And my expectation is the market will be improving. The buyers will be extra nervous next year. If I did not have to sell at the moment, I personally would not feel inclined to sell at the moment. I'll be looking to wait until, a bit more of a, I don't know about a frenzy, but whatever, the FOMO is going up next year. So personally, I would be waiting, because why would you want to sell at the bottom of the cycle unless you need the money for something else?
Yeah. Terence says, with the housing downturn, do you think it's possible DTIs will no longer be something that will be implemented?
No, there was a comment from the Reserve Bank. I'm not sure if it was in a monetary policy statement, press release, or a financial stability report, basically indicating, and I'm pretty sure it was about May next year, is sort of things are on schedule for that. They had to, I think, delay it a bit from beyond what they were hoping for, because the banks need to get all their systems in place. There's a hell of a lot, when we're talking about millions of mortgages, etc. The last thing you want is the banks not having the computer systems, and these can be expensive to rejig and reclassify everything. So I'm thinking it's about May next year. Yeah.
Greg says that the Queenstown market's bucking the trend with rising rents and strong house prices. Any commentary on that?
Oh yeah, no, Queenstown is always a market all off to itself. I've said this many years ago, 3 decades ago. You can talk about the overall New Zealand housing market, but strip out the Auckland inner city apartment market there and strip out Queenstown, / Wanaka as well. They've got their own very special dynamics, so don't automatically translate whatever any macroeconomist like myself says for either Auckland inner city or for Queenstown, where I didn't put it down there. I think they're already well into sellers market, strong FOMO, the rising prices, the whole kahuna.
Jonathan asks, how much do you think government overspending is causing inflation?
Yeah, fairly strongly. The government spending in combination, however, with the Reserve Bank keeping interest rates too low for too long. 2020, I'm not going to criticise either government spending actions or the Reserve Bank, even removing the LVRs. That was fine. It was a crisis situation. They successfully averted here and overseas a depression situation as a result of, we were all running around like headless chooks for a few weeks there, and our own houses were locked down in 2020. They should have recognised all of them over 2021. The economy had already regained its pre-pandemic size before the end of 2020. So my criticism is of the actions of many parties in 2021, that they should then have pulled back and not tried to get so many shovel-ready projects, mainly because fiscal policy is a longer-term thing. I'd put the blame for the Reserve Bank. Not as bad as the Reserve Bank of Australia, where still late in 21 into 22, the Reserve Bank governor was saying, we're not raising interest rates till 2024. Central banks have something to answer for their actions around the world in 2021, definitely.
Do you have any comments on inflation predictions as a result of Ukraine grain deal collapsing? It seems that that will be a massive influencer on world grain prices and therefore world food prices.
Yeah, higher grain prices. I mean, there was a reaction straight away in the markets there. So yeah, it definitely brings some inflation risk. But we've got to remember, at the same time, in the past 2 months, we've seen a massive turnaround in views on likely growth in the Chinese economy. 2.5 months ago, the view was, they're recovering well after embracing the horror of COVID in the second week of December last year. And now the commentary, it's all negative. The data are bad on retail spending, capital investment, exports, factory production, construction, demand for Aussie iron ore and coal, etc. And of course, we've got supply chains functioning better out there. So I think those factors will outweigh what might anyway be a temporary upward pressure on the grain prices there. I don't know, depending on if they find another route out or if they sign a new agreement with the Russians. I haven't got the foggiest, but the track for inflation is going down. But like I say, if this is one of the factors in the mix there, there's still massive uncertainty out there, and everybody is still going to be having to change their interest rate and inflation forecast over the next 18 months, still like we haven't seen for a couple of decades or so.
Paul says, aren't they putting DTIs in the toolbox and not necessarily applying it?
Certainly, the in the toolbox. Yeah, the Reserve Bank has asked for them, and the Finance Minister has given them to them. But I was of the impression that they are bringing them in next year. They may not have. They haven't announced a date of May 1 versus May 30 or 31. But I can recall the indication was given of about May last year. It may be that they just leave them in the toolbox. The Reserve Bank is certainly of the view that there is no need for them at the moment, but they wanted them in the toolbox, and I guess the opportunity presents itself for them to put them in place. But that's why I say there could be a rejigging with the LVRs, because I just made a note I don't want to get too complicated here, but LVRs are aimed at addressing the risk of house prices falling away, and all of a sudden the bank has lent to you here, but the value of the asset they mark to market is there, and the bank has to report that loss. So that's what LVRs are addressed at. Stress tests are to address the risk of interest rates rising sharply, and oh my God, you can't service the mortgage, so then you're a forced weak seller there. DTIs are addressing the risk that your income falls away. That the unemployment rate rises and people can't be servicing the mortgages any longer. That's the sort of risk that they are looking at addressing. And then there's the fourth one of the bank capital adequacy rules, just to help as a mix on the whole thing. So we're looking at sort of a 4-tool regime there for the Reserve Bank to be influencing bank exposure to housing market weakness, income weakness, high interest rates, all those sort of things. So like I say, it could just be a bit of a rebalancing and have the 4 tools running along. Who wouldn't want to have that situation at hand?
We'll just do 2 more questions, just because we've taken enough of your time, Tony. Time's getting on. This is the question for us. The National Party has put in writing that they will remove the existing non-interest deductibility rules on rental properties, and based on the current poll, our poll, at 92%, say there'll be a change of government. Based on the poll, I've lost my place, they're going to remove the interest deductibility rules on rental properties, and based on the current poll, would you take the risk to purchase existing rentals as an investment now and take the timing advantage rather than paying a premium to get a new build as an investment?
Only if you can afford to get it wrong. If you're wrong, and the market, doesn't rise as you're expecting, are you going to get weeded out? If the answer is yes, you cannot afford to take the risk. Just because one might be prepared to take a risk on a thing, sometimes you simply cannot take the risk of being wrong. Now, people maybe have a look every now and then at the the core logic buyer classification data on the people that are doing the purchases of properties. On average, 21% of property is bought by first home buyers. It's recently running at 25%. And they split the investors there broadly into those who are using debt to purchase and those who don't use debt to purchase. And what's happened is the investors using debt has gone down, but the proportion that are not using debt to make their purchase has still remained relatively firm. I don't know, maybe it's 13 or 14% sort of through that. So those sort of people, maybe, they're willing to take the punt. It doesn't really matter for their particular investing model. But yeah, you got to be able to afford to get it wrong. It's like, if you don't do the crime, if you can't do the time.
Yeah, what I would add to that is I'm Mac, isn't it? Mac Pang. Mac, I am buying houses in this market, but I have a plan B for them. So the plan B for interest deductibility is that I can either rent them to the government and then I get an exemption, or I'm buying assets that need to be reclared, because if you reclared 75%, then they are exempt. The new CCC gives you an interest exemption. So you just try and fit into what, get another angle on the asset. And then if we get surprised and we do get this government, then you can still get there.
You accountants. Sorry, God. Oh my God. I did listen to about a year ago to an accountant give a presentation on all of these rules, and I thought, oh my God. Yeah, it pays to get advice to know exactly if you're going to be compliant on that or not. Matthew, just while you're there, before you get to the final question, because as an accountant, you'll be over this a bit better than me. My understanding is National have said, back in power, restore interest expense deductibility, take the bright line from 10 years back to 2 years, but they have not made any mention of changing the ring fencing.
I've been chasing a couple of politicians on that. Paul Goldsmith said that they're looking at it, but they wonder if they can afford it, which is, hold that up to the light. It's no. But the other two things are exactly what's going on. But then Chris Bishop said the other day, with forked tongue, that they are going to remove interest deductibility and they will phase it out.
Right. Yes.
So he said that they're a fiscal constraint. So I think they're going to hold up the carrot and then they're going to remove it slowly, which is better than not removing it. Yep. David Seymour's a whole lot more aggressive on that. He's emphatic that interest non-deductibility has to go straight away.
Yeah, people should realise that Labor look like they're going to do what Labor always do when they're going to lose. They open up the spigots a bit and they leave a fiscal mess for the incoming national government, and it looks like that's going to happen again, partly because tax revenue is surprising on the downside. That doesn't usually happen in New Zealand. More often than not, the tax receipts are higher than Treasury expectations, but this year they're actually lower than expectations. So yes, fiscal policy is going to have to be addressed by the incoming government. I wouldn't call it austerity, but yeah, it wouldn't surprise me at all if there's just, right, we're not any longer going ahead with anything to do with the three waters or whatever, stop centralisation, computer systems here, that and the other, and push out some of these tax changes.
Yeah, well, I think that Chris Hipkins has got a big paintbrush and he's painting out the leopard spots and he's trying to look a whole lot more bland than this government actually is. So time will tell. I think we'll wrap it there. Tony, great presentation. Thank you very much. As always, it's on point and not a lot that I could disagree with. So I hope that your predictions come true. Interest rates ease off next year and we see some growth return to the market. I know that my client base will welcome that. Hopefully you'll come back and talk to us again, perhaps after the election, and hopefully we're celebrating.
Yeah, hopefully we will be. Yeah, but who knows what's going to happen. It depends what happens on a Sunday night at whatever time in the morning if the dogs can find them. So there we go.
Right. Well, thank you very much. And just to close off, we've got this webinar series continuing. Next week, we've got Simon O'Connor, who's a town planner, and that'll probably be a faster presentation. And what we'll be doing there is going over the RMA changes and helping you pick by area across the country, and exactly how these RMA changes with medium density residential standards are going to affect your local area for zoning. There's so much money to be made out of that, and it's played a big part of my investing. So for me, I only want to invest in areas that are getting upzoned through MDRS. Rotorua is one of them, but Tauranga, Auckland, Wellington, Whangarei, and Christchurch are the main ones getting it. And I think Central Otago, Queenstown Lake District, that area is also getting it. So if you're investing in these areas where suddenly you can put in high density housing, there's a lot of money to be made out of that. So we're going to talk about that next week. Great presentation from Tony. If you need help with your tax and legal stuff, or if you need help with your property, GRA are property accountants. We'd love to hear from you. No doubt you know our website because you booked in it. And if you want to book, there's a meeting. There's a request a meeting in the top right corner there. So we'll see you next week with Simon O'Connor. Thank you again to Tony, and we'll wrap it there. Thanks, everybody. Good night.